Good evening, everyone, and welcome. I'm Tyler Matheson.
And I'm Sue Herrera, in tonight for Susie Garab. It was an ugly day at the open. It was even uglier at the close. However, strong earnings from Disney could change the tone tomorrow. But we begin tonight with that $80 billion deal that seems to be dead. 21st Century Fox has withdrawn its bid to acquire Time Warner. In a statement, Chairman and CEO Rupert Murdoch said Time Warner management and its board refused to engage with his company or even explore a higher offer. He also said the bid drove 21st Century Fox shares lower, undervaluing the company and upsetting too many shareholders. Fox did approve a new $6 billion stock buyback plan. Shares of Time Warner initially dropped sharply after the announcement. Fox went the other way, with shares spiking right after the news.
But is the deal really dead? Let's get some thoughts now from Tom Egan. He's a senior research analyst with the Telsey Advisory Group, and he follows media companies. Welcome, Tom. Good to have you with us, Tom. Do you believe that Mr. Murdoch is going to go away, and if permanently, and if so, why did he?
I think the deal for Time Warner is dead. You know, we weren't sure about it to begin with. We had it pegged at about a 50-50 shot, and that's essentially because the net debt leverage to EBITDA ratio was going to be too high.
You know, Tom, there are those, though, who say that basically Murdoch is raising more cash, he's going to make it a sweeter offer, and that eventually he'll be successful. Why don't you think that that's in the cards?
Well, even if you include the proceeds that they get from their sale of Sky Deutschland and Sky Italia, if the bid is 50% cash, which I think is what Time Warner needs and wants, it's still higher cash. And so the leverage still goes to above 4 times.
You know, Mr. Bucas at Time Warner has succeeded in getting his stock price up, but the cost has been perhaps selling other elements of the company, Time Warner Cable, the publishing group, Time Inc., breaking them apart. That makes Time Warner more digestible to another company. Is there another company that might find Time Warner too delicious to pass up? I'm thinking of Google.
Well, it's possible there could be an OTT or a tech company that's interested, but to us, there wasn't another media company that was going to make a bid. So to us, we saw Rupert Murdoch really negotiating against himself.
I would assume that it's going to be very important to watch the dialogue that goes back and forth as investors and analysts and shareholders basically digest what's happened late this afternoon. So what are you going to be listening for from both sides in this discussion?
Well, at Time Warner, Jeff Bucas still needs to show shareholders how he's going to, enhance values, whether that's expanding HBO internationally, whether that is improving the ratings at Turner, whether that is increasing share at Warner Brothers. So he still has to show how he can increase value. At Fox, I don't think that they're done yet. So they were willing to spend $75 to $80 billion for Time Warner. They just issued or increased authorization for share repurchases by $6 billion. There could be more to go here.
You seem to be saying, Tom, that the deal did not make financial sense for Fox, and that seems to be their conclusion at the leverage ratios that you described. Did it make business sense?
Well, I had a couple issues with that deal. For example, you're merging Warner Brothers and Fox Studios. So, I mean, Warner Brothers was about 40% of the company revenue. So what would they have done with 2 times the studio? So I'm not sure if it made complete sense to me.
All right, Tom, thank you very much. Tom Egan, Telsey Advisory Group, we appreciate your perspective tonight.
Sure.